by UBRA, and this is Miss RITAH NANSASI, who is a lawyer and he's the Director of Legal Services at the Uganda Benefits Regulatory Authority, which is a government body that regulates all pension schemes in Uganda that have been licensed to actually help people save for their retirement. Most welcome, Miss RITAH, to the program.
Thank you, Mr. Anthony.
Yes. Now, let's start right away with this, new regulation, kind of, if I could call it. First of all, how did this come about, and who thought about this, and why is it important right now at this moment?
Okay, thank you, Anthony, and thank you, our viewers, for tuning in. My name is RITAH NANSASI WASWA, as introduced, the Director of Legal Services at the Uganda Retirement Benefits Regulatory Authority. And what informed these regulations is our Section 68(2)A of the UBRA Act. When Parliament was enacting the UBRA Act, they put in a provision that enables a member to assign a certain proportion of their retirement benefits for purposes of purchasing a residential house. So these regulations that were recently enacted come in to give effect to this section of the UBRA Act, whereby a member that has been saving with a retirement benefit scheme for 10 or more years can be allowed to assign up to a maximum of 50% of their retirement benefits for purposes of purchasing a residential house.
Yes, you corrected me that it's not actually access like we have put it, but assign. So meaning you cannot literally go and get this money,
no,
but
can't.
You can assign.
Yes. Okay. The difference between access is that with access you have to pay out. For example, like the midterm access of 20%, that 20% is paid out. But with these regulations, the retirement benefit schemes are not going to pay out this 50%. However, they will give this member a guarantee and a letter of undertaking that you can go to a bank or to an institution and get a loan or a mortgage of up to 50% of your retirement benefits, and the schemes undertake to cover in case of default. So there won't be any payment of this 50%, but when you take this letter to a bank or to an institution, you are a good borrower because this now acts as security. On top of probably the land or the house that you'd like to renovate, you have additional security. So it makes you a better borrower, and banks will look at you preferably more than someone who comes without any collateral or security.
Yes. Now let's talk about, yes, you say these can supplement. Let's talk about the mortgage loan itself. Which kind of loans have you looked at? Because you say that you can either, you want to renovate or construct. Can you also buy a new property or something like that?
Okay, in the regulations, we've gone ahead to define what amounts to a residential house. Okay. What amounts to purchasing a residential house. This includes purchasing, actual buying of a house, an already constructed house, or you could already have your plot of land and you have failed to construct. So you could borrow this money with the security of your benefits and construct a house on that land that you have. Or you could have your residential house that you're staying in and you need money to renovate or upgrade the house. So you could still use these regulations to borrow a loan or a mortgage to improve your residential house. And the regulations also go ahead to cover the costs of, say, the valuation fees, the stamp duties that are normally hindering people when they're getting more. Definition has been extended to cover all those extents. Why we're doing this is because we believe, like in Social Security, a house is a very important aspect. We don't want members of schemes to retire and then start struggling to construct a house. So government put in place these regulations to enable everyone that has been contributing to a scheme to have a residential house. So at the point of retirement, at least you have a roof over your head. Yes.
Now, let's talk a little bit more about the people that actually can access this. Of course, some people have been saving with the scheme, but maybe there are people who went earlier, maybe there are people who have just joined. Does it capture everyone who has been saving with these pension schemes that are licensed by UBRA?
Okay, thank you for that question. These regulations are specific. They clearly say that you should have saved for at least 10 years. We believe that if you've saved for 10 years, at least you have sufficient balance upon which this guarantee can be issued. Because if I've just joined the scheme today or just 2 years down the road, I haven't accumulated enough savings that could be sufficient collateral. So a member who has just newly joined will not be able to benefit. However, if you continue saving up to 10 years, you will surely be able to benefit. Then those that have already left retirement benefit schemes, probably you're already in retirement, unfortunately, you may not be able to benefit from these regulations because you're already out of the bracket that is contributing. So it's for those that have contributed for 10 or more years and continue to contribute. And it's also a requirement that you should be in gainful employment, because essentially these regulations are not aimed at enabling a member to prematurely access their retirement benefits, but rather to use them as collateral. So it means as you're going in for this mortgage or loan, you should have a source of income with which you're going to use to pay this mortgage or loan. The regulations will only, the benefits will only be looked at as a last resort in case a member fails to pay this loan and probably they're approaching retirement or they've lost a job. That's when then these financial institutions can reach out to the schemes to help the member offset the outstanding balance of these using these retirement benefits.
All right. In case now I fail to pay probably this loan, and they have to take my benefits out, can I only have these as securities, or like you said, I have to have like another security, for example, to back up? This is like you call the backup, right? Yes. So can I have it in entirety? Like my security is the 50%, or it's a must, I actually have to have another security added to this 50%?
Okay, I think it would be good for you to have an additional security, for example, a plot of land, in addition to this 50% that you're getting as a guarantee. Because even when you walk into a bank and all you have is this letter of undertaking, I believe they won't look at you in the same light as someone who comes into the bank with an already existing plot of land, in addition to the 50% letter of undertaking. So it would be good for a member that wants to use this benefit to have something to start with. For starters, at least a plot of land or an existing house. So these retirement benefits are used as a second collateral, an additional collateral, and that makes you a better borrower than someone who is only going to come to a bank with only that letter of undertaking. So when you come with your land and these benefits, I believe you'll be able to get better interest rates because you're a better borrower, you're less risky than someone who is only coming in with this letter of undertaking. And we also believe that someone who has worked for at least 10 years, in a bare minimum, you could have a plot of land. Probably all you need is money to start constructing on this plot of land. So it puts you in a better position, and it also enables you to get preferential rates from the banks and financial institutions. Oh yes,
I wanted to talk about the rates. I wanted to know if there is an influence on the rates as per this regulation, in that people who are coming in with this 50% as their security are given maybe a favor in terms of lower rates or something like that.
We have been engaging the Uganda Bankers Association and a number of commercial banks are members in this association. So we believe that during the implementation of these regulations, the members of schemes should be able to be given preferential rates. Just like I said earlier, if this member already has an existing plot of land and now they're coming again with the 50% undertaking or assignment, this member should be looked at as a better borrower, less risky than someone who comes without any collateral at all. So we believe that financial institutions will find it appropriate to give members of retirement benefit schemes preferential rates so that they can be able to construct their houses or renovate their houses, or those that have land and have it constructed to be able to construct, or rather to purchase an already constructed house. Yes.
Recently, of course, there has been an argument. People want to access their benefits. People want to start, before 50, is it 55? The age at which,
retirement age.
Yes. People want to, pull out, these monies. Is this now like this new regulation? Is it a way of, helping people actually access? Okay, not access like you don't want me to use, but of now opening up people, getting to be able to actually benefit from their, savings before they actually retire.
Okay, thank you for that question. This. For the members that want to access their benefits, already government has put a window for those that have been contributing to NSSF. Government has allowed them through the NSSF Amendment Act to access up to 20% of their retirement benefits as the midterm access. This money will be paid out. You could go for the 20%, you could go for 10, 15 or less. However, these regulations, as I said earlier, and I continue to emphasize, are not to allow a member access, but rather use your benefits as security, as a guarantee to go into a bank and borrow a loan or a mortgage. Because we noticed that you don't have to wait until you're 50, 55 or 60 to construct a residential house. You can start probably at 30, 40 or even earlier, depending on the balance you have on your account. So these regulations are ready to provide an alternative. Instead of going for the 20% payout, I would rather go for the 50% guarantee that enables me to get more money and do more than probably the 20% that would have been paid out. So this is like an alternative, and we advise members to also look at this option and see, because we feel it's a better option than the payout. Because when you pay out, you're even going to lose out on interest. But with the 50% guarantee, your money remains in the scheme. That you get this letter of undertaking, go to a bank and borrow money and start constructing your house. The money has remained in the scheme, you're using it as security, and it's earning you an interest. So actually, you're benefiting. Yes.
Wow, that is very interesting. Now, let's talk about the pension schemes that are going to actually benefit from this. We've talked about the National Social Security Fund. How about the other schemes? Will they as well benefit equally from this?
Yes, all the over 65 schemes licensed by UBRA will be able to benefit from these regulations. What the schemes need to do, what the trustees are the decision makers in these schemes. All they need to do is to amend their trust deed to allow the members of the respective schemes to benefit from these regulations. I think if you saw the press release that was issued by the MD of NSSF, he also indicated they are seeking stakeholder consultations to amend the NSSF Act so as to enable the members of NSSF to benefit. So this is clearly to state that for members to benefit, there should be a change in their existing trust. These are documents that constitute the scheme. For NSSF, it's NSSF Act, it has to be amended to allow this product now for members to benefit from it. From the other 64 licensed schemes, they have to amend their trust deeds so that the members of these schemes can benefit from this new regulation. And at least every member has a residential house. They have a roof over their head at the point of retirement.
Now, looking at this as a new regulation, for it to be passed, did it go through the scrutiny, like the way we saw the NSSF Act, which went through Parliament, it did all this. Now, did this have to as well go through all those, or actually there was a bypass?
Okay, regulations are made by an enabling act of Parliament. And unless the Act of Parliament requires that regulations are supposed to be taken to Parliament, most times regulations are not required to go to Parliament. They are passed by the minister, just signed by the minister and published in the Gazette. So under the UBRA Act, there is no requirement for the regulations made thereunder to be presented to Parliament.
Okay.
But rather, when we're making these regulations, we consult several stakeholders, because it is a legal requirement. We're drafting a regulation to consult a number of stakeholders. So while coming up with these regulations, we consulted members of several retirement benefit schemes, we consulted trustees, we consulted the Uganda Bankers Association, we consulted several stakeholders to see that we get their buy-in and their feel about this new product that is being introduced by these regulations. So once the consultations were completed, the draft regulations were sent to the Solicitor General. That is the process. The Solicitor General has to clear these regulations for the minister to sign, just to make sure they do not conflict or contradict any other existing laws. So once they are cleared by the Solicitor General, then they are signed by the minister. Upon the minister's signature, they are published in the Uganda Gazette. Then they get the force of law and members benefit. So these regulations were published in the Uganda Gazette. After following that lengthy procedure, on 25th February, they were published in the Gazette. So to date, they have the force of law.
Yes. To just take you back a little bit, many people are still, skeptical about, saving for retirement. And as a matter of fact, they look at this in a way that, how secure are the funds, how, people are sometimes, run away with money in schemes. You now as a regulator and now the legal, service director at the UBRA, what are some of the measures that have been taken to encourage the public in order to feel safe and build that confidence that our money is actually safe in the hands of our pension schemes?
Okay, thank you. What the regulator has done, what government did in order to build confidence, first of all, they required for the separation of roles. Initially, before the UBRA Act was enacted, you would find the person collecting the funds is the person investing the funds, is the person paying out. But now there's a requirement to separate these roles. The funds are collected and kept by by a custodian. A custodian is a financial institution. So we have about 5 licensed financial institutions that keep this money. So when your money is collected in a retirement benefit scheme, it's not kept in the drawers in that scheme. It's kept on a separate bank account. And then this money has to be invested by fund managers. These are licensed professionals that advise on the different asset classes as prescribed by the authority, wherein these funds have to be invested so that the member gets their money and a return on investments. So all this is intended to ensure that the members' funds are not eroded. And to build confidence in the members, to encourage them to save, the UBRA, which is the regulator, supervises the custodians. These are banks, and they're also supervised by Bank of Uganda. The fund managers, who are professional investors, are supervised and regulated by ourselves. We give them a license, in addition to the license they get from the Capital Markets Authority. Then the administrators that are responsible for keeping records of the schemes are licensed by us, as well as the trustees who make decisions in these schemes. So there are several layers to ensure the safety and safe custody of members' funds, and just to build the trust and confidence that the regulator is overseeing all these players and members' monies are safe. So we encourage every Ugandan to save for retirement, because it's a reality. We all shall retire at some point. It's just a matter of time. So if you retire and you haven't saved, then you're going to retire into poverty and you become a destitute. So we encourage every Ugandan to save for retirement. We've also gone ahead to license schemes tailored for the informal sector workers, because although they may not collect remit savings in informal sector schemes, they are tailored schemes that they can contribute to. And recently the NSF amendment also allowed informal sector workers to contribute to the NSSF. So this clearly shows you that it is very important for everyone to contribute towards their retirement. And just to give Ugandans the comfort, your money is safe, properly invested, and UBRA is overseeing this money wherever it is invested. Yes,
well, let's talk about the informal sector as well. You know, that has been for quite some time. The informal sector has been put out of, you know, the saving, you know, for retirement thing, and they have actually just been allowed to access these services. Is there a law in particular that has been amended for them to go through so that they can actually still, you know, participate in the saving for retirement?
Okay. For the informal sector workers to be able to contribute to NSSF, yes. The recently enacted NSSF Act, the amendment, included a provision that enables the self-employed and the people in the informal sector to contribute for their retirement by remitting money into the NSSF. But even before this amendment, UBRA had already licensed 2 schemes that are properly tailored for the informal sector workers. Because you know that informal sector workers don't have regular income. Their income is intermittent. Today they make money, tomorrow they don't make. So their schemes have to be specifically tailored that they can contribute as and when they get this money. And this is different from you and me who are in the formal sector arrangement, where we know every month the salary comes and the contributions are deducted. This is not the case for the informal sector person who is self-employed, who has to remit this money and deduct it from their own income. So their schemes have been tailored to suit their characteristics, and there are already 2 schemes existing, the Mazima Retirement Benefit Scheme and the Kasita. And we also have a number of umbrella schemes that accept these informal sector workers and self-employed persons, and recently the NSF amendment also allowed them to contribute and remit their savings into NSSF.
Yes. Back to the 50% you know, security that we want to access. There are people who have saved for 10 years for sure, but probably their 50% is not as significant, because of course we earn differently.
True. And
people save differently. Yes. And I understand NSSF takes away, is it what percentage of income?
It's 15%. Your employer remits 10 and 5 is deducted from you.
Yes. Now, how about those people who actually have served for 10 years? Yes, the law has covered them. You have served for 10 years, but probably what they want, the dream they have, the dream house they have, and what they have on their account, and even the other supplementary securities they have, they don't add up. Does the law cover for such cases?
What I can say is that, of course, as you've rightly noted, we all get different salaries, and that means the level of contribution is different. Yes. So this law says you should have contributed for 10 years. So depending on the balance that you have on your account, that will also inform the mortgage or the loan that you can get. So the advice to these people is that go for what fits within your means. Cut your coat according to your cloth.
Yes.
So if you have a balance of, for example, 500 million, you could go for a bigger mortgage. But if you have a smaller balance, go for a facility that fits within your funds or your credit. Because what is important at the end of the day is for you to have a decent accommodation. It doesn't have to be a mansion, it doesn't have to be a very big house, but decent accommodation that suits you, so that when you retire, at least you're guaranteed of a roof over your head. So all these people, even if you have low balances, you shouldn't worry. Go for that product or that loan that suits within your credit on your account.
Yes. Now, well, there's going to be an argument as well. Yes, you have looked at the housing, the housing loans and stuff. Yes. Now, people are going to say, oh, now you see, there's also health insurance. Maybe someone says, okay, now what if I'm constructing a house and I'm not healthy and I may not live in that house at the end of the day? Yes. Have you already thought through some other loans as well, such as school fees loans, salary loans, that we could use this 50% still as security for?
Okay, under the UBRA Act, the provision, section 68(2)(a), did not envisage the school fees loans and education loans. However, health was envisaged.
Okay.
Health is already provided for.
Okay.
So what I can inform the members that we're already in advanced stages of developing similar regulations that we've done for the mortgages and loans to cover the health, because that has already been provided for in section 68(2), where a member can still assign a portion of their benefits to cover their medical bills. Yes. So this is already a work in progress, and members should be assured that when the regulations are ready, they'll still go through the same process, and then members will be able to use their benefits to cover their medical bills. But under the UBRA Act, this does not extend to education and other probably short-term needs. We believe the balance that the member retains after remitting the 5%, after deducting the 5%, this should be able to meet the other needs.
50%.
So that, sorry, 5. Remember, they contribute 15%.
Yes.
Your employer puts in 5%
okay.
for 10% for you, and from your salary, your wage, 5% is deducted, meaning you remain with 95%. So we believe that 95% should be able to help you meet your other needs. While this other 15% that has been kept for you is kept for your retirement. So the only leverage that has been created is to allow you to assign 50% for a residential house and also for medical bills. And we're working on the regulations to enable members benefit for their medical needs.
Yes. We're going to go into a short break, but when we return, we want to talk a little bit more about now the pension schemes, the legal structures and framework of the pension scheme. There are many people out there with SACCOs, with so many other things, and they don't have this docket of retirement saving. So we're going to talk about the legal aspects of that as well. But before we go into that break, I just wanted you to just like kind of summarize what people should expect, and what people who have been saving with NSSF and all these other pension schemes should understand concerning this new regulation.
Okay, what the members should understand that for you to benefit from these regulations, first of all, you should have contributed for 10 years or more. You should be in gainful employment, because this regulation, these mortgages or the assignment that you're going to be given requires that you already have a source of income with which you're going to use to service this loan or mortgage. The retirement benefits would only be used as a last resort in case of default. But we expect members to be able to service their loans and mortgages. We're only allowing them to use 50% as collateral. So there won't be any payout, but the trustees will give you a letter of undertaking. Just like the case is for salary loans, your employer gives you a letter of undertaking, you take it to a bank and get a loan which you're able to pay. So it is a similar arrangement.
Wow. Thank you very much. Ladies and gentlemen, I'm still talking to Miss RITAH NANSASI WASWA, who is the Director Legal Services at the Uganda Retirement Benefits Regulatory Authority, a body that actually regulates pension schemes such as NSSF and make sure they invest your money for retirement so that you can actually get benefits from that retirement saving that you are making with them. We are going to go into a short break, but when we return, now we are looking at the pension schemes. Pension schemes are those schemes that you come up with in your respective, organizations or, your groups that help you actually save for retirement in particular. We want to talk about the legal aspect of that when we return. Don't go anywhere. We are going to be right back.